What if I told you the rich aren't paying as much tax as you think, and you could legally do the same? Now, while tax evasion is illegal and can land a person in jail when discovered, tax avoidance, on the other hand, is totally legal. Well, here's the good news. Most of the tax laws in the US, especially the IRS code, could be circumvented. What this means is that there are legal loopholes that could save you thousands of dollars in taxes if properly used. So, let's begin. Here are a few legal loopholes. First, there are commuter benefits, which can be a huge way of saving money rather than spending it on taxes. It's offered in the workplace and can be purchased for up to $70 for most employees when properly used. It was discovered that you could spend up to $300 a month tax-free on commuting. There's a $300 deduction on tax, which could amount to $3,600 a year. This is said to be applicable to ride-sharing apps like Uber or Lyft, train services, bus services, parking garages, parking meters, and more. You can transport yourself to and from work, save yourself some money without having to pay taxes a few times as long as you haven't passed that $300 threshold. Next on the list is the Health Savings Account, or as we know it, the HSA. Now, this is a high savings account for people with high deductible health plans, which will enable them to save on medical expenses. So basically, how this works is if a person pulls all their money into a health savings account and spends it on medical expenses, say drugs, healthcare, visits to the doctor, and paying for emergency care services, the person would be free from paying taxes on those expenses. In simple terms, a health savings account helps a person save all their money without having to give a dime to the government. It's great, right? So basically, it's a tax-free savings account. Additionally, if you invest using the funds saved in HSA, your investment earnings are not usually taxed. Next, there's the Child Tax Credit, which essentially helps families with children who qualify under the Act get a tax break. The qualifying child includes your child, niece, nephew, stepchild, guardian, half-brother, half-sister, or even a grandchild. The Child Tax Credit states that depending on one's income, the person could take an amount up to $2,000 per child as a credit against their tax bill. Taking the credit could help lower their tax bill or even take the taxes owed down to zero. That's a tax win for the whole family. More toys, more laptops, more games for the kids. Another beautiful thing about this Child Tax Credit is that one can claim the credit even if the adult doesn't usually file a tax return. Another loophole is the FSA, which is known as a flexible spending account. This is a savings account which allows one to pay a certain healthcare expense with pre-tax money. This means that most of the spending done from an FSA account is mostly tax-free money. However, there is a bit of a downside to the hack. If the money stays in the FSA till the end of the year, it can be lost, except in situations when a company rolls it over. Another important one on the list is the foreign-derived intangible income. This income is a portion of the U.S. corporation's intangible income that comes from serving foreign markets. The White House says an intellectual property loophole was enacted by the Trump tax plan, which allows corporations to get tax breaks by moving assets abroad. In the real estate sector, there are a number of loopholes that can help a person avoid taxes, especially because real estate is one sector that's usually heavily taxed, as investors are often expected to file their total income without hiding anything. The first instance is when a property, or a house, is sold by a person. The person is expected to pay a capital gains tax on that profit made from the house. However, if the money is immediately used to reinvest in another property, those taxes could be deferred. This basically entails reinvesting in another property shortly after making profits. Next up on the real estate radar is a concept known as depreciation, one of my favorites. This one is considered a game changer. The government gives a person the grace of deducting the wear and tear on a property from their taxable income. And here's the secret. Even if the value of the person's property keeps appreciating over time, it's still possible to claim depreciation and reduce the monetary value of the tax bill. This is a strategy employed by real estate moguls while also making waves in the bank. It seems like those in the real estate industry are really enjoying the loopholes in the law. Have you heard about the Augusta rule? Yeah, that's the rule that allows a person to rent out their home for up to 14 days a year completely tax-free. This means if you possess a nice house in a popular area, you could rent it out during a peak time, like a big event or a holiday, and not pay a dime on taxes on that income. So long as this home is not your primary place of residence or business, you can rent it out for up to 14 days. Which means you don't have to report the income on your individual tax return. However, there is a side note. The rent you charge has to be reasonable and in line with what the rental market supports. Charging $1,000 a night when comparable houses rent for $200 a night is not considered reasonable. Let's talk about the 529 plan, which is another well-meaning tax loophole that enables a person to save up for their child's education without having to go through the hassles of filing a tax return. Now, this is a plan that allows one to put money away for their education, their child's education, or even a family member's. When funds are pulled into a 529 plan, the IRS often offers a tax deduction on the savings. Sadly, while you may not receive a tax deduction on your state's income taxes, some states will still not give a tax deduction on 529 plans. An example of such state is California. Now, there's a home office deduction too, often available for remote workers, business individuals, and entrepreneurs who use their place of residence for business purposes for the sole purpose of making profits. Suppose your entire home or a portion thereof is exclusively used for business. Well, that means it's possible to deduct expenses like rent, utilities, and even internet bills. That's a gold mine right there. Now, another successful hack that's been proven to work overtime is actually employing your family members to help out in your business. It's no news that children are usually taxed lower than adults. Some not at all. In situations where you need more hands in running your business, think of your kids. That way, it'll be easier to claim deductions on wages paid and receive a lower tax rate, even as low as 0%, which is always optimal. Hey, have you ever considered keeping long-term capital gains? This one is for my crypto or stock enthusiasts who have held stock or crypto for up to a year or more. These stocks are usually considered long-term capital gains. The tax rate applied on long-term capital gains is generally lower than that of a regular tax rate. If the person is under a certain threshold, then the person could qualify for a 0% tax rate and the profits made tax-free. The S-corporation loophole is another loophole worth considering. Now, I don't think we've heard anything like it before, but certainly there is, and the tax code specifically makes provision for it. This pertains to business owners, and it's that code that allows a business owner to avoid Social Security, Medicare, or self-employment tax on a portion of his business profits. That's $1,000 saved on taxes. Moving on, there's the retirement benefits plan, where the law allows a person to plan for their future without having to remit a fraction of the money to the government in the name of taxes. This is often known as the traditional IRA. The traditional IRA is a retirement plan set up outside of a person's workplace. Apart from having the company set up a retirement plan for you, it's also possible to set one up yourself, and it's likely to qualify for a tax deduction to keep money in your traditional IRA. Remember this when you're sipping a pina colada on the beach, thinking about all those taxes you were able to save from the government. Another highly evasive legal loophole that helps a person save up on taxes is a backdoor Roth IRA. Now, it is worth noting, though, for the new tax year in 2025, single filers and heads of households earning over $165,000 annually are barred from contributing to a Roth IRA, which allows tax savings to grow tax-free. Unfortunately, married couples who file jointly and earn over $246,000 in 2025 also lose the ability to contribute directly to a Roth IRA. It's also important to note that since the early 2010s, high-income earners have been able to circumvent this limit by converting their traditional IRA into a Roth IRA. Once income taxes get paid on the initial contributions and gains, retirement savings could grow tax-free without required minimum distributions, or RMDs. Now, with this loophole, you can contribute way more than the normal limit through your 401k and then roll it into a Roth IRA. This means more tax-free money for retirement plans. Now, let's talk gambling losses. Now, I know it sounds funny, and gambling is certainly not a smart investment plan, but it's highly possible to avoid paying taxes when a person's been hit by a fatal blow and then later goes on to win in one of their gambling sprees. So when a person maybe wins big at the casino or the horse track, normally the casino or track will send you a copy of their winnings to the IRS alongside a tax form called a W-2G tax form, which is then handed over to them for filing. Now, the normal thing is to file all of their winnings on the tax form, or else they could be sent to jail. Now, here comes the interesting part. Instead of writing their entire wins in a W-2G form, it's possible to write your losses that you had before and everything that you lost while gambling on sports, horses, casinos, or whatever. Now, that way, the government takes note of what you lost during your gambling spree and doesn't charge you the normal or regular tax rate. You could whittle your taxes on that gambling victory all the way down, depending on the circumstances of your situation. So even if you lose your ticket, don't rip it up. Keep it. It could be a nice tax reducer. Now, when filling out your 1099-B form, don't forget to deduct the margin interest. This is a very useful tool in saving taxes. It's very, very important. If you're an investor looking to pull your weight into a large investment hedge fund, look at long-term capital gains. Yes, long-term capital gains like stocks, bonds, mutual bonds, and even real estate have a lower and more favorable tax treatment than short-term. An investor who holds a capital gain for as long as 1 year is liable for a 0%, 2%, or even 20% interest on the capital gain, and thus would be required to pay way less taxes according to the person's income level. Now let's talk about starting a business. Don't be surprised to know that you can actually avoid paying taxes by just doing something as simple as starting a new business venture. If you've been stalling on that business, start now. Starting a new business for the sole purpose of making profits could also be a way of avoiding taxes legally. So yeah, start that business. As explained earlier, it'll be better when the business starts from the house. That way, you'll be eligible for home office deductions. The duty will, however, lie with the IRS, which will evaluate several factors to determine whether taxpayers who realize a profit in 3 or 5 years are presumed to be engaged in a business for profit. So you better be there for the profit. Now consider Section 179 of the IRS Code. This code is also known as the immediate expense deduction, which business owners can take for purchases of depreciated business equipment, vehicles, and software. Now, this allows businesses to lower their tax liability for the income tax year rather than capitalizing an asset and depreciating it over time in future tax years. Section 179 often provides an incentive for small business owners to grow their business with the purchase of new equipment, and it would consequently provide substantial tax relief. And finally, the most controversial but legal loophole often used by the top 1% of the society is borrowing against assets instead of selling them. This is mostly done by the wealthy members of society as a way of avoiding taxes. They would take out loans against their stocks and real estate instead of selling them. That way, even the assets will appreciate over time. Now, this is usually done because, unlike incomes, loans are often tax-free. Benefits accrued as an employee are other funds accrued aside from the retirement plan benefits. The loophole in this IRS code allows employees to exclude the contributions made or benefits they receive from their income, thereby helping to lower the amount of taxes payable. Most benefits under these programs are referred to as non-taxed incomes under the W-2 statements created by the employer. These benefits include, but are not limited to, educational assistance programs, adoption expense reimbursement, transportation costs, and group life term insurance for up to $50,000. The legal loopholes used to avoid taxes have to be done with wisdom and utmost care. If anyone's found avoiding taxes outside of the boundaries of the law, it could result in punishment, payments of fines, or even jail time, depending on the circumstances and gravity of the tax evasion. Thanks for watching, and we'll catch you in our next video. Happy deducting!